Are you concerned about the new tax law changes and how it's going to affect your personal finances? Today, I'm diving into the tax law changes that were implemented because of the new One Big Beautiful Bill, or OB3, talking about how it's going to affect your personal finances and what you need to do about it. I'm Dakota Grady, DG the Money Coach, and I'm all about helping you to master your finances. Let's dive into the conversation. You're here because you want to understand the new tax law changes that were implemented because of the OB3, the One Big Beautiful Bill. So the first thing we're going to talk about is the standard deduction for 2025 and 2026. So for 2025, we're talking about single, married, filing jointly, and also heads of household. So for 2025, under the OB3, the single, as you can see, is $15,750, right? But for 2026, it's $16,100, all right? And then for married, filing jointly, the standard deduction is $31,500, and for 2026, it's $32,200. And for heads of household, you got $23,625 for 2025 and $24,150 for 2026. So those numbers for between both years are increased for inflation, because when prices go up, they want to give, the IRS wants to give a little cost of living increase, so they're incorporating the increase because of things increase over time. Prices, inflation, things go up. So let's look at 2025, $31,000 for a standard deduction. That's pretty neat. I like that increase right there. I mean, if you are married and you have about $60,000, half your income gonna be cut in, your income may be cut in half by half of that, basically. So you're making $60K and you're married, filing jointly, and your income, you're gonna pay tax on $30,000 roughly because of that big standard deduction. So I want to give kudos to the IRS for that one. The next one I feel like is a benefit, because if you want to plan for your giving for 2026, I recommend using the annual exclusion. For 2026, the annual exclusion is $19,000. That is, basically you can give someone, actually it's $19,000 for 2025 and 2026. So you can give someone $19,000 as a gift and not pay tax on that. So basically you give up to a certain amount before it is taxable. So you have a big amount, which is the gift tax. I think it was like 2024, like $13 million. Anything above that would be taxable to you. So if you have a big income or you have a lot of wealth and you're giving a lot of it away, potentially it can be taxable. But if you're giving over $19,000 to somewhere, that will probably go toward your gift tax in the future. One important change according to tax law is the senior exemption. So personal exemptions have gone away as of 2017 when the Tax Cuts and Jobs Act was implemented. And now it's basically permanently done away with that deduction. There's one personal exemption that still remains, and that's the senior exemption, and that's for 2025 and 2025 through 2028. Basically, if you're a senior over 65 years old, you can get a $6,000 additional deduction. And of course, that fades out. But in order to get that particular deduction, you have to, of course, have a Social Security number. And if you're married, filing jointly, that's the only way you can get it. You can't get it if you're filing separate. So make sure you get this deduction. If you're married, both taxpayers get that $6,000 deduction, which is pretty awesome in my opinion. Then people have children, right? So I believe that the child tax credit is something that helps people with children. The IRS benefits you if you have a family. If you're married, filing joint, if you have children, you get higher deductions, standard deduction, and you get also tax credits. If you have children, child tax credit has basically been increased to $2,200 per child and refundable up to $1,700. Now, they're really emphasizing having a Social Security number. It's required now. So make sure if you want to take this tax credit for your children, make sure you have a Social Security number. The other dependent credit, it remains at $500, and nothing has changed on that right there. Now, one thing that was really hot in tax law was the SALT deduction, basically the state and local tax deduction. So on Schedule A, you basically get to deduct up to $10,000 of state taxes. Well, now with the new change, the cap has increased from $10,000 to $40,000 for 2025, and it phases down for higher incomes, and it's going to revert back to $10K in 2029. So for 3 years, well, actually from 25 to 28, we're going to have a big deduction. If you itemize, you can itemize up to $40,000 in taxes. So you got a big tax bill for your property taxes, and you're paying property taxes to the state. Well, you can deduct that big $40,000 if you had a big estate, say a big piece of property. $40,000 can be your deduction, itemized deduction. But you can only take the deduction if you itemize. Also, another hot topic is no tips or no taxes on tips in overtime. But it's not really no tax. It's actually, let's dive into it. For tips, basically, there's a $25,000 deduction per taxpayer. And for certain occupations, people get tips. And the tips starting in 2026 must be reported on your W-2. So it's up to the employer for 2025 to determine what are tips and what are not tips. If you're getting tips on 1099 or 1099 miscellaneous or 1099 NEC, which is now non-employee compensation, you have to report those tips on forms for 2026. But the whole point is you're going to deduct up to $25,000 of your tip income. So if you're a waitress or waiter, busting tables, restaurants, maybe you cutting hair, you get tips. You can deduct up to $25,000 of your wages become a deduction. So you won't report that in income. The next one would be overtime. You can get a $12,500 deduction if you're married filing joint. Deduction is $25,000. So, and it's overtime exceeding regular rate of pay. And again, it requires Social Security number and filing a joint return. So you can't just get this deduction if you file a separate. It's better to file jointly. It's advantageous to file jointly because you get more deduction, you get more benefits of filing jointly opposed to filing separate and being single. And one thing the new president wanted to do is create savings account for young kids. And it's called the Trump account. It's a new tax advantage account for children under 18 in 2025 and 2028. That's 3 years, or roughly 4 years. And they can contribute up to $5,000. And it's supposed to be a government giving $1,000 to fund this account and saying that it's going to take effect 12 months. So this OB3 was enacted on July 4th of this year, 2025. So it'll be next year, basically, before they start using or creating these accounts for people. Now, it says that you can do an election to establish a Trump account. It can be made by a Secretary of Treasury. And then based on information they already have available, of course, they have all your information. Or it can be created by a parent or guardian. So again, it's one account per child. And when a child becomes over 18, it'll revert to a traditional IRA or individual retirement arrangement or account. One thing I think is important is a benefit if you have children, you want to have children, or if you can't have children, you want to adopt children. There's a benefit for you because you get an adoption credit. Now, you now can get a credit up to $5,000 that's refundable. So the credit for 2026 is $17,670. And of that amount, you can get a $5,000 refundable credit, which is pretty awesome. You can use that money to go help with other expenses for the child. Now for 2025, that credit is $17,280. Another major change to tax law with OB3 is the 1099Ks, the 1099 forms. What happened, the threshold went back. It was, if you had a 1099 and you made $600, you might need to report a 1099 to the person, whether it's NEC, miscellaneous, or 1099K, basically reporting income for that particular person. Say I do accounting and taxes, so I would get a 1099 NEC from my clients because they pay me $600 or more. Well, that has been changed now. According to the new OB3, threshold has been restored to $20,000 and 200 transactions for 1099Ks, which basically is at 1099 if you get payment card processing, say you use PayPal or Square, Venmo, they're supposed to send you a form to 99K showing you made it to, you had how many transactions and you had this much amount of money, right? It was threshold of $600, but now it's reverted to $20,000 and then 200 transactions. If you blow that threshold, you won't get a 1099K, right, going forward. And if you receive 1099 miscellaneous or 1099 NEC, the threshold is now increased to $2,000 instead of $600. So, and that's starting as of January 1st of 2026, so next year. And then you also get, if you have any cryptocurrency, you're selling those, you get a 1099 DA, which is basically a digital asset proceeds from broker transactions. 2025, they're going to report any proceeds that you had, but not the cost basis, which is basically the amount that you purchased the original asset, digital currency. But for 2026, brokers are required to report gross proceeds and cost basis for covered securities, which were basically assets that were digital assets that were purchased on or after 1/1/26. This is major because in the past, they would just ask you a question about did you make any sales or dispositions or of any digital assets. Now they're requiring you to report the information, report it anyway when you get your broker statement, but still, now you're going to get a actual 1099 DA that you want to send to your tax preparer and report that income. One thing that the former president had implemented was the clean vehicle credits, right? Well, the new president had basically just terminated the new clean vehicle credits, whether it's a used vehicle or a new one. They're no longer available of 10/1/2025. So if you bought a vehicle that was an EV, electrical vehicle, as of 10/1, you can't get the credit. So basically, you only get the credit from 1/1/25 to 9/30/25. Even with the home efficiency credits, they've been terminated as well. And they go through 12/31/25. So if you still have time, buy things that are energy efficient for 2025, you have to the end of this year to make the purchases in order to take the credit on your 2025 tax return. One thing I also see in the new tax law changes is the qualified presidential interest. $750,000, that's the maximum amount of debt you can basically incur. Anything above that, you can't deduct. It's basically a cap on mortgage interest deduction. Now mortgage insurance premiums are treated as interest as of 1/1/26 if you itemize. If you have a business, this is important for you because now we're talking about business meals. Have receipts for expenses of $75 or more, except for lodging. And to substantiate, you must have the amount, time, place, the business purpose, and business relationship for the business meal. There was a new tax law change that could come to 100% deduction for meals provided in certain fishing vessels and at remote fishing processing facilities for amounts paid or incurred after 12/31/25. So basically, it sounds like people who are on the ships who are out fishing, they now can deduct if they have a business. If it's a business and they have employees, they can deduct the meals that they're eating on the ships. If you're in school and you're getting the American Opportunity Credit, that's required for the Social Security number of the taxpayer and the student. And you also have to have an EIN or employer identification number from the institution. It's also for the lifetime learning credit as well. Again, that really emphasizing the importance of having a Social Security number. So basically trying to prevent people who aren't resident aliens or U.S. citizens from getting the benefits of being resident citizens of the U.S. There have been many disasters too lately with hurricanes and tornadoes. You can get disaster relief and casualty loss deduction, which now allows for personal casualty losses to be deducted if attributable to either a federal declared disaster or a state declared one. In the past, it's always been one for federal, but now they're including the state federal disasters too. And it's the same, $100 per casualty and 10% AGI, that means adjusted gross income, floor apply and for qualified disaster losses. Now, there's also a $500 casualty and no 10% AGI floor may still apply, depending on the specific disaster relief provisions in effect. So this is major for those who are in areas who have been hit by tornado, disasters, floods, fires. And this was one major topic that was also in discussion, which is for businesses, qualified business income deduction, or QBID, QBID. And the rules remain the same, the core rules, but deduction is now made permanent in phases in for ranges of wages and property, and service-based businesses are expanded from $75,000 to $150,000, and a new $4 minimum deduction is introduced for taxpayers of at least $1,000 in QBI for active businesses. Allow more people to get the deduction for having a small business. Most people, especially business owners, really like, I believe it'll be a benefit, is the bonus depreciation. In fact, the OB3 permanently restores 100% bonus depreciation for qualified property acquired and placed in service after January 19, 2025, and introduces no new expensing opportunities for production-related real property. So, in other words, bonus depreciation is a type of depreciation where you get that year one, you can write off the entire asset, basically. So a lot of businesses like this has benefited because it had phased down, I think, to like maybe 40%, I believe. Now it's restored to 100% as of January 19th, 2025. If you bought assets before that date, then you can't get the bonus depreciation of 100%. I think this is huge for small businesses because depreciation is one way to really, really reduce your taxable income. And it's one of the tax strategies that I believe everyone needs to take advantage of. Another part of depreciation is Section 179, which basically allows you to deduct up to a certain amount. So it has been increased from $1 million, which is inflation adjusted, to $2.5 million. So it's a big amount. So anything above that amount, $2.5 million, it basically is reduced in terms of how much you can deduct above that amount. But again, depreciation is a major tax strategy that everyone who has a business should be able to take advantage of and benefit from. I know this was a lot of information, but my whole point is to give you a value on new tax law changes that you can help lower your taxable income, take advantage of the deductions, credits that you are allowed to take, and save you money. Make sure you meet with your tax preparer, professional through the year, so that you not only take advantage of the credits and deductions, but make sure you withhold enough money from your wages, if you're an employee, or if you have a business, make sure you're doing your quarterly estimates so that you won't owe tax at the end of the year. And if you do owe tax, make sure it's not a whole lot. I hope this was beneficial to y'all. I'll be adding more value to y'all when things come up, when it comes to tax law changes and personal finances. If you want to continue to receive information, please like, share, comment, and subscribe to the channel. And keep watching the next video to get more information about finances to change your life. And I'll see you there.